Welcome to the Explainer. So, if you're a focused learner trying to steadily build wealth over the long haul, you've probably figured out that putting your money on autopilot, investing a fixed amount on a regular schedule, is an absolute powerhouse of a strategy. It takes all the emotion right out of the equation and just lets time do the heavy lifting. Globally, this is often called a systematic investment plan, or SIP. But where exactly should you be funneling those recurring dollars? Okay, let's dive into this.
It really brings us to the ultimate dilemma every investor faces when setting up their long-term wealth strategy. You want to invest, you need to do it consistently. And look, both exchange-traded funds and mutual funds give you amazing diversification, professional management, the whole shebang. But, as we're going to explore today, they're actually built very differently when it comes to trading, pricing, hidden fees, and taxes. And honestly, picking the wrong vehicle for your specific situation could mean leaving some serious cash on the table.
But before we break them apart, let's just quickly review the mechanics of what we're actually doing here. This is dollar cost averaging in action. You set up a system. Step 1, you dedicate, say, $500 a month. Step 2, you automate it to buy into the market on the first of every month. And step 3, which, let's be real, is the hardest one for our brains to handle, you completely ignore the short-term market conditions. When the market is booming, your $500 buys fewer shares, but when it inevitably dips and everyone else is panicking, your steady $500 is in there automatically scooping up more shares on clearance. It literally forces you to buy the dip when your instinct is yelling at you to run away. It's a fantastic, deeply stabilizing rhythm for building wealth.
So let's define our first contender, the Exchange-Traded Fund, or ETF. Essentially, it holds a basket of investments, like stocks or bonds, and a lot of them track major indexes. What's really cool about an ETF is that grabbing just one single share gives you immediate exposure to a massive index, like the S&P 500. So instead of needing an absolute fortune to meticulously buy fractional shares of 500 individual companies, you just buy this one fund, and boom, you instantly own a tiny slice of all of them. And in the other corner, we have the mutual fund. Much like an ETF, a mutual fund pools money from thousands of investors to buy a huge, diversified portfolio. But if we really want to optimize our strategy, we need to establish a baseline understanding of how its underlying machinery is different from an ETF. And honestly, the biggest fundamental difference comes down to exactly when and how the fund is priced and traded.
Right, so here is that first major structural difference. ETFs trade exactly like stocks. If the market is open, you are free to buy or sell your ETF shares all day long, catching those minute-by-minute price movements. Mutual funds, on the other hand, do not give you that intraday control. Buying a mutual fund at noon is kind of like ordering off a restaurant menu that doesn't have any prices on it, and you only find out what your meal actually cost after the market closes. Your order gets locked in and executed at the fund's net asset value, or NAV, which is calculated just once at the very end of the business day. Now, for a totally hands-off long-term investor, that might not matter one bit. But if having that intraday flexibility is your thing, the ETF definitely holds the structural advantage there.
Okay, let's shift gears to a super critical topic, fees. And we really want to lean into expert suggestions here, because this is where wealth is quietly won or lost. The Securities and Exchange Commission, the SEC, puts out a very direct warning to investors about this. They explicitly state that higher fund costs reduce investor returns, and they urge you to rigorously compare total costs. Both ETFs and mutual funds come with management fees and operating expenses. And yeah, they might look like tiny little fractions of a percent, but the experts at the SEC are warning us that these hidden drags can absolutely gut your long-term wealth.
Let's look at exactly what the SEC is talking about here. Imagine we have two identical index funds, Fund A and Fund B. They both generate the exact same gross annual return of 8%, but Fund A has an annual expense ratio of 0.10%, while Fund B charges 0.75%. And this brilliantly illustrates the illusion of fees. To the naked eye, a 0.65% difference looks like a tiny, totally negligible rounding error, right?
I mean, it's less than 1%, no big deal. Actually, wrong. It's a huge deal. I need you to understand just how urgent this microscopic little number really is. Investing is a compounding game. Over 10, 20, or 30 years, that 0.65% is continually siphoned out of your balance. It completely robs that money of its ability to stay in your account and grow upon itself. That tiny fraction can literally devour tens of thousands of dollars of your potential wealth. This is exactly why the experts insist you never judge a fund just by its past performance. You absolutely have to scrutinize the expense ratio.
Now, beyond fees, we really have to talk about taxes. And for this, we're bringing an expert explanation straight from the IRS.
They note that mutual fund capital gain distributions are generally reported to investors as taxable capital gains. And here is the trap. If a mutual fund manager decides to sell some securities inside the fund to rebalance it and they realize a gain, they distribute those capital gains directly to you, the shareholder. It is incredibly frustrating. It's basically like splitting a dinner bill for super expensive appetizers that you didn't even eat. You get stuck with the tax bill just because the fund manager was doing some house cleaning, even if you personally didn't sell a single share of your mutual fund all year.
Now, compare that to an ETF. As the SEC points out, ETFs historically offer much better tax efficiency. It all comes down to their unique structure and the way they handle these things called in-kind transactions with authorized participants. Basically, ETFs typically pass on way fewer capital gain distributions than a comparable mutual fund. And that makes ETFs highly advantageous if you want to keep more of your money rapidly shielded from that unexpected tax drag year after year.
Real-world example, Sarah's $500 a month dilemma. All right, abstract expert advice is fantastic, but let's actually ground this into a tangible situation. Let's introduce our hypothetical American investor, Sarah. So, Sarah is 35 years old. She's decided to completely automate her financial life by investing $500 every single month for the next 30 years. She's assuming an 8% average annual return before expenses, and she's trying to decide between a low-cost ETF or an identical mutual fund. Now notice that over those 30 years, her actual out-of-pocket contributions are going to total exactly $180,000. It is an amazing demonstration of just how powerful, consistent, automated discipline can be.
So the crucial point is, if she just sticks to this plan and lets compound interest do its thing without interrupting it, her ending balance could be right around $745,000. Just let that sink in for a second. From $180,000 to nearly $750,000. But remember, the exact vehicle she chooses and the type of account she holds it in is going to dictate exactly how much of that $745,000 she actually gets to keep. Which brings us to the ultimate deciding factor here, the account type. If Sarah is investing this money in a standard, taxable brokerage account, the ETF almost certainly wins, hands down, because of that tax efficiency we just talked about. She avoids those surprise capital gains taxes. But if Sarah is investing this cash inside a tax-advantaged account, like her employer's 401k or a traditional IRA, well, those mutual fund tax inefficiencies don't really matter in the same way, right? The account itself shields the money from taxes while it grows. So in that specific tax-sheltered environment, a mutual fund might actually be the absolute flawless fit. But hey, before we just crown ETFs the universal winner for all taxable accounts, let's look at one more expert warning from the SEC. They remind us that ETFs can have transaction costs and bid-ask spreads that investors really need to consider. So don't just assume every ETF is flawlessly superior. If you pick an ETF with a super narrow, hyper-specific strategy or one that just isn't traded very often, you might get hit with wide bid-ask spreads. That basically means the gap between what a buyer wants to pay and what a seller is demanding is awkwardly large. And that right there is a hidden cost that can erode your returns, just like a high expense ratio would. So to synthesize this expert consensus, let's break down exactly when each vehicle really shines. Mutual funds make incredible sense when your top priority is straightforward, totally hands-off, automatic investing. I mean, they are the absolute bedrock of employer 401k plans for a reason. They're fantastic for taking exact, fractional amounts of a biweekly paycheck and automatically sweeping it right into the market. Plus, they offer incredibly seamless built-in dividend reinvestment. For absolute convenience and automation inside a retirement account, mutual funds are seriously hard to beat.
On the flip side, ETFs are overwhelmingly considered the smarter choice for long-term wealth building if you're operating inside a normal taxable brokerage account. They offer unmatched low costs combined with really high tax efficiency. They give you the flexibility to trade intraday if you ever find yourself needing to, and they provide broad market exposure with fantastic transparency. Because ETFs actually publish their holdings every single day, whereas mutual funds report on a way slower schedule. Ultimately, the expert suggestion from financial data and regulatory bodies like the SEC boils down to this: choosing a suitable, low-cost index fund and sticking to the process for decades is always going to be trying to predict tomorrow's market swings. Constantly jumping back and forth between an ETF and a mutual fund to chase a fraction of a percent, that's a losing game. The real driver of wealth is the habit of regular, disciplined investing. Basically, so I'll leave you with this to reflect on your own financial habits. Which investment vehicle gives you a strategy that you can consistently automate and follow for years without losing sleep? because at the end of the day, the one you can actually stick with through all the market's ups and downs, that is ultimately the smartest choice for you.